Ryan Leman. He's the Neovision Wealth Management CEO and co-founder. Ryan, you've been in the region for many, many years. Could you quantify for our global audience what kind of tailwind this latest move by the Dubai government could bring?
Good morning, Yusuf. Well, that's, as mentioned by your colleague, that's a surprising move. And I think it enhances the competitive advantage of Dubai as a touristic place. Many of the friends I receive here in the UAE who go to Dubai, obviously, they always complain about the same thing, alcohol prices. I think this could be a game changer for Dubai.
To what extent does it make a material difference? Maybe it doesn't, but maybe it will for stocks listed on the Dubai exchange. I mean, there isn't necessarily the biggest representation of tourism and hospitality names. You know, it's sort of more telcos and, some other defensive plays. But what's your read on the allure of Dubai stocks in 2023 vis-a-vis what the rest of the region has to offer?
Well, this decision regarding alcohol, I doubt it will have a big fundamental effect on stocks on DFM, as you mentioned. It might have some sort of a momentum or positive momentum driver. Now, regarding Dubai stocks and UAE stocks in general, with the high IBOR rates, we do think that companies' earnings will suffer a little bit. However, we remain quite positive. We are on dividend-paying stocks. We are on cash flow positive stocks. We are on government-related companies, and we remain positive on the UAE and GCC in general.
Ryan, in 2022, the strength of the dollar was a tailwind for much of the Gulf. Now, with the dollar potentially peaking, what used to be a tailwind could easily become a headwind and a source of additional inflationary waves over the next 6 to 9 months. To what extent is that on your radar?
Absolutely, you're absolutely right. So this has been positive for the GCC, negative for other emerging markets who don't have currencies pegged to the dollar. However, lower dollar is good for other emerging markets who do trade with the GCC. So we can get some compensation from there. Second, on oil prices, we do expect oil prices to go up again, and this is also beneficial for the GCC. So net, we think that the effect will be neutral. Let's not forget that the airline industry is consuming 2 million barrels a day less than they used to consume before the pandemic. Now with the China reopening, with travel back on the menu, we do think there will be some pressure on the demand side for oil prices going up, which is beneficial for the GCC. So it will compensate.
From the sort of view on equities, I just want to take you to the fundamentals in Saudi Arabia. And yes, they've got a lot going for them, but I look at the interbank rate, and we had this drama around the SAIBOR, the Saudi interbank rate, with quite a bit of pressure on liquidity. There were a lot of questions and sort of there was a bit of confusion about why that was occurring. How does that set us up for 2023? And do you expect sort of the recent move lower to stick, or is there still more pain to come?
Well, SAIBOR is quite high, and there's clearly some sort of a crunch. It's not really a big concern for us. So something is happening on the funding side. This will be negative regarding companies who need funding. So financials, banks, people will take less loans, etc. And that's why we're placed elsewhere regarding the Saudi market. Now, regarding pain, no, we don't think it's over yet. We do think that the hiking cycle is still ongoing in the US, though it's around its end. So we do see some increase in the SAIBOR coming in the future. So no, we don't think the pain is over, but it's manageable.
I love the note out from Saudi National Bank Capital, SMB Capital. They're saying that the Saudi stock market is enjoying a different tune, a different rhythm is the verbatim from that. Can you subscribe to that view, and sort of what's your top call for this year?
Well, we've been subscribed to that for quite some time today. We believe in the medium to long-term performance of the Saudi market and the UAE market for that matter. It is an energy play, and Saudi Arabia made it clear they are energy exporters, and the play is mainly energy and utilities in our opinion, and this is how we're playing it. Free cash flow positive, dividend paying with an upside thanks to this play. Despite the fact that the SAIBOR will eat away a little bit of these profits, but it remains largely positive.
The other thing that you like is high quality credit and short, lower quality ones, Turkey and Egypt. Is there a certain duration that you attach to that call?
Well, it's the shorter duration, obviously. We prefer to stay away from the longer duration for obvious reasons. We are a little bit concerned about Egypt with the US dollar crunch, the basically absence of US dollars at the moment. We do think that higher interest rates will make lower quality credit suffer, so the borrowers, and hence the short, despite it being expensive. So it's more on the shorter duration on the long side and slightly longer on the short side.
Ryan, great to see you, and thank you for helping set the tone at the beginning of the new year. That is Ryan Lemant. He's the New Vision Wealth Management CEO and co-founder.